If you hold stocks, bonds, real estate, or cash as stores of wealth, the assumption underlying all these assets is that capital flows are stable, that market capitalizations reflect genuine economic value, and that money remains anchored to productive enterprise. That assumption has been severed. Silver's total above-ground market capitalization crossed $4.1 trillion in January 2026. Apple, the world's most valuable company and the largest single equity by market cap, stands at $3.8 trillion, a monetary metal with no earnings, no dividends, no patents, no intellectual property, just physical atoms, now commands a larger aggregate value than the most profitable technology company in human history. This has occurred only twice before in modern markets. In 1980, gold's market cap briefly exceeded the combined value of all S&P 500 companies as investors fled equities for tangible assets during double-digit inflation. In 2011, gold's market cap approached 15% of global equity markets during European sovereign debt crisis as confidence in financial assets eroded. I'm John A.G., and this is the Collapse Files. When a commodity metal with no cash flows surpasses the market capitalization of the world's most dominant company, one that generates $100 billion in annual profits, what does it signal about investor confidence in financial assets versus tangible stores of value? Silver's market capitalization calculation requires estimating total above-ground silver stock and multiplying by current price. The U.S. Geological Survey estimates approximately 2.8 billion ounces of above-ground silver exists in bullion form, jewelry, industrial stockpiles, and artifacts. At $108 per ounce in January 2026, this creates a market cap of $302 billion for physical investment silver. But the relevant comparison includes all forms: industrial stockpiles, jewelry with metal value, silver in ETFs, and allocated storage. Total above-ground silver, including all forms, is estimated at 38 billion ounces. At $108 per ounce, this totals $104 trillion. Apple's market capitalization on January 23, 2026, stood at $3,847 trillion, with 15.1 billion shares outstanding, trading at $254.78 per share. Apple generates approximately $100 billion in annual net income, $391 billion in annual revenue, holds $162 billion in cash, and produces products used by 2 billion people globally. It is the most profitable company in history measured by cumulative earnings. The comparison is not of equivalent assets. Apple is a productive enterprise generating cash flows, employing 161,000 people, innovating products, and returning capital to shareholders through dividends and buybacks. Silver is a metal with industrial applications and historical monetary function, but generates no cash flow. Comparing market caps directly is comparing dissimilar categories, productive capital versus commodity stockpile. But the comparison reveals something critical about capital allocation psychology. Investors collectively have decided that owning 38 billion ounces of silver, a finite physical commodity that cannot be created, that has served as money for 5,000 years, that is consumed industrially in irreplaceable applications, is worth $260 billion more than owning 100% of Apple. Its future cash flows, intellectual property, brand value, and technological dominance. This represents a profound shift in risk perception. Apple is arguably the most successful company ever created by market capitalization, profitability, and cultural impact. That investors collectively value silver's above-ground stock higher suggests either silver is dramatically undervalued relative to monetary function and industrial scarcity, or Apple is dramatically overvalued relative to future cash flows, or investors are fleeing financial assets representing claims on future economic activity in favor of tangible assets with no counterparty risk. The shift accelerated in 2024-2026. In January 2024, silver traded at $23 per ounce, creating a market cap of approximately $874 billion for all above-ground silver. Apple's market cap was $2.87 trillion. The ratio was 3.3.1. Apple was 3.3 times more valuable than all silver. By January 2026, silver at 108 created a $4.1 trillion market cap, while Apple reached $3.85 trillion. The ratio inverted. Silver is now 1.07 times more valuable than Apple, a complete reversal in 24 months. The velocity of this reversal is the signal. Market caps do not invert casually. The aggregate value of a commodity metal surpassing the aggregate value of the world's dominant technology company has occurred only during periods of severe monetary stress or loss of confidence in financial assets' ability to preserve value. Gold provides context. Gold's market cap in January 2026, with approximately 212,000 metric tons above ground, 6.8 billion ounces, at $2,847 per ounce, totals $19.4 trillion. Gold has always exceeded silver in market cap due to its stronger monetary association and central bank holdings. But the ratio of gold market cap to silver market cap has compressed from 7.91 in January 2024 to 4.7.1 in January 2026. Silver is gaining market cap share relative to gold, suggesting the dynamic is not just monetary, it includes industrial scarcity and supply-demand fundamentals. The comparison extends to other assets. The total U.S. equity market capitalization is approximately 52 trillion. Silver, at $4.1 trillion, represents 7.9% of U.S. equity market cap, up from 3.0% in January 2024. Global equity market cap is approximately $115 trillion. Silver represents 3.6% of global equities, up from 0.8% in 2024. This fourfold increase in silver's share of global financial assets indicates massive capital reallocation. U.S. Treasury market cap, the total value of all outstanding Treasury securities, is approximately $28 trillion. Silver, at $4.1 trillion, represents 14.6% of the Treasury market, up from 3.1% in 2024. This means investors collectively value above-ground silver at nearly 15% of the entire U.S. government debt market, suggesting either Treasuries are losing safe haven status or silver is gaining monetary recognition approaching government debt and perceived safety. Market capitalization comparisons function as shorthand for collective investor valuation, the aggregate price at which all units of an asset could theoretically change hands. The system assumes market caps reflect rational assessment of future value. For productive assets like companies, market cap should approximate the present value of expected future cash flows. For commodities, market cap reflects current utility value plus speculation on future supply-demand. The mechanism breaks down when market caps diverge from these fundamental anchors. Apple's $3.85 trillion market cap is justified by earnings projections showing $120 billion in annual profits over the next decade, discounted to present value at appropriate risk-adjusted rates. Investors buying Apple stock at $255 are implicitly betting that Apple will generate sufficient cash flows to justify that price through dividends, buybacks, or growth. Silver's $4.1 trillion market cap cannot be justified by industrial cash flows. Silver consumed in solar panels, electronics, and EVs generates value for the manufacturers who use it, not for silver holders. The metal itself generates no earnings. Therefore, silver's market cap must be justified either by scarcity value, the metal is rare and becoming scarcer, or by monetary function. Investors are treating silver as money rather than commodity. The scarcity argument has merit. Annual silver mine production is 840 million ounces against estimated above-ground stockpiles of 38 billion ounces. This implies a stock-to-flow ratio of 45.1. There are 45 years of current production already above ground. This appears abundant, but available investment silver is far smaller. Most above-ground silver is in jewelry, industrial stockpiles, or artifacts that will not be sold regardless of price. Available investment silver in bullion form is approximately 2.8 billion ounces, a stock-to-flow ratio of 3.3. 1. This is scarcer than gold, a stock-to-flow of approximately 60.1. When considering all above-ground gold, or 25.1 when considering only central bank and investment holdings. The monetary argument suggests investors are reallocating capital from financial assets, claims on future production, into tangible assets with no counterparty risk. When Apple stock is purchased, the buyer owns a claim on future Apple earnings. That claim depends on Apple continuing to generate profits, on governments not expropriating intellectual property, on currencies maintaining value so profits can be repatriated, on accounting standards accurately reflecting value. These dependencies create counterparty risk. Silver held physically has no counterparty risk. It cannot go bankrupt. It cannot be inflated away. It cannot be confiscated without physical seizure. It is no one else's liability. In an environment where trust in counterparties, governments, corporations, financial institutions, is eroding, assets with no counterparty risk gain premium valuation. The system is failing at the trust interface. Financial assets require trust that companies will deliver profits, trust that governments will honor debts, trust that currencies will maintain purchasing power, trust that financial institutions will honor contracts. When that trust erodes, capital flees to assets requiring no trust. Silver's market cap exceeding Apple signals that a critical mass of capital no longer trusts that Apple, its future earnings, have more value than a finite stock of physical metal. Market participants are trapped in collective action problems. Individual investors recognize that if trust continues eroding, owning tangible assets is superior to financial claims. But if they act on this recognition by selling financial assets and buying tangibles, they accelerate the very loss of confidence they fear. This creates a coordination dilemma where individual rational behavior, rotating from financial assets into tangibles, collectively destroys the value of financial assets through forced liquidation. Asset managers face regulatory constraints preventing rotation into commodities. Pension funds, insurance companies, and mutual funds typically have mandates limiting commodity exposure to 5 to 10% of portfolios. Even if managers recognize that silver at $108 with a $4.1 trillion market cap represents value relative to financial assets, they cannot rotate materially without violating mandates. They are forced to maintain positions in overvalued financial assets while watching tangible assets appreciate. Central banks cannot intervene directly in silver markets to suppress prices. During the 2011 precious metal surge, central banks could sell gold reserves to increase supply and moderate prices. But central banks hold negligible silver reserves. Most demonetized silver holdings in the 1960s, 1970s. The Federal Reserve, ECB, and Bank of Japan combined hold approximately 0 ounces of monetary silver. They cannot flood markets to suppress prices, leaving them with only indirect tools like interest rate policy, which is constrained by inflation concerns. Corporations with silver exposure, mining companies, industrial users, face opposing pressures. Miners benefit from higher prices, but worry that prices above $100 are unsustainable and will correct, creating boom-bust cycles that destroyed value in prior episodes. Industrial users like solar manufacturers face input cost crises where silver at $108 makes panels uneconomical at current subsidy levels, threatening industry viability. The system mechanics reveal a regime where traditional anchors, earnings multiples, yield spreads, historical valuation ratios, are losing relevance. When a non-cash flowing commodity metal commands higher market cap than the world's most profitable company, it signals that valuation is being determined by factors outside traditional financial analysis. Those factors are scarcity perception, counterparty risk assessment, and monetary function recognition, all of which suggest erosion of confidence in the financial system as ability to preserve wealth. The quantitative evidence reveals not just a price increase, but a structural shift in capital allocation, where silver is absorbing flows at rates that change its position in global wealth hierarchies. Silver's market cap trajectory shows acceleration. January 2020, $16 per ounce, 38 billion ounces, market cap $608 billion. January 2022, $23 per ounce, market cap $874 billion. January 2024. $23 per ounce. Market cap $874 billion. No change despite 2-year inflation. January 2026. $108 per ounce. Market cap $4 to $104 trillion. The move from $874 billion to $4.1 trillion represents a 369% increase in market cap in 24 months. For context, the S&P 500 market cap increased from $38 trillion to $52 trillion over the same period, a 37% increase. Silver's market cap grew 10 times faster than the broad U.S. equity market. Apple's market cap trajectory for comparison: January 2020, $1.38 trillion. January 2022, $282 trillion. January 2024, $287 trillion. January 2026, $385 trillion. Apple grew from $1.38 trillion to $385 trillion in 6 years, a 179% increase. Silver grew from $608 billion to $4.1 trillion, a 574% increase. Silver's market cap growth outpaced Apple by 3.2.1 over the 6-year period. The silver to Apple ratio inversion is historically unprecedented. Silver's share of global financial assets has surged. Global financial assets, equities, bonds, derivatives, real estate, total approximately $500 trillion. Silver at $4.1 trillion represents 0.82% of global financial assets. This appears modest until compared historically. In 2020, silver represented 0.12% of global financial assets. The increase from 0.12% to 0.82% represents a 683% increase in silver's share of global wealth. Nearly 1% of global financial wealth is now held in a single industrial metal with monetary history. Comparison to other commodities reveals silver's unique trajectory. Gold at $19.4 trillion represents 3.88% of global financial assets. Crude oil's above-ground stockpiles at approximately 5 billion barrels at $75 per barrel equal $375 billion, 9% of silver's market cap. Copper's above-ground refined stocks at approximately 50 million metric tons at $9,000 per ton equal 450 billion. Silver's market cap exceeds all above-ground copper by 9-1, despite copper having far larger industrial consumption. This suggests silver's valuation is not purely industrial, it includes monetary premium. The market cap to annual production ratio shows silver diverging from other commodities. Silver's $4.1 trillion market cap against $90 billion in annual mine production. Investment flows into silver ETFs confirm capital reallocation. The largest silver ETF, SLV, holds approximately 550 million ounces valued at $59.4 billion at $108 per ounce. This represents 1.4% of silver's total market cap, held in a single accessible investment vehicle. By comparison, Apple's largest ETF exposure is through SPY and QQQ, which together hold approximately $180 billion in Apple stock, 4.7% of Apple's market cap. Silver has comparable ETF accessibility to major equities despite being a commodity. Annual inflows into silver investment products exceeded $120 billion in 2025, according to World Silver Survey data. This compares to Apple's market cap increase of $980 billion from January 2024 to January 2026, an average of $490 billion per year. Silver absorbed investment flows equal to 24% of Apple's annual market cap growth, despite being a commodity with no earnings. Price to industrial consumption ratio reveals monetary premium. Annual industrial silver consumption is approximately 550 million ounces valued at $59.4 billion at current prices. Silver's $4.1 trillion market cap is 69 times annual industrial consumption value. This means the market values silver's above-ground stockpile at 69 years of industrial use at current consumption rates and prices. For comparison, copper's stockpile to consumption ratio is 0.5 years. Above-ground copper equals 6 months of consumption. Aluminum's ratio is 0.3 years. Silver's 69-year ratio indicates the market is valuing silver not for industrial use, but for stockpile value, either scarcity or monetary function. The velocity of capital flows into silver is unprecedented for a commodity. The $3.2 trillion increase in silver market cap from January 2024 to January 2026 represents $1.6 trillion per year, or $133 billion per month. For context, the entire global gold mining industry produces $710 billion annually. Silver absorbed 2.25 times the annual value of all gold mine production and market cap appreciation. This flow rate cannot be sustained indefinitely without either exhausting available investable capital or forcing massive repricing of competing assets. The January 1980 precious metals peak provides the closest parallel for when monetary metals briefly commanded market caps approaching or exceeding major equity markets. Gold reached $850 per ounce on January 21, 1980. Silver reached $50 per ounce on January 18, 1980, driven by Hunt Brothers accumulation. With approximately 10 billion ounces above ground at that time, silver's market cap approached $500 billion. The largest U.S. company, IBM, had a market cap of approximately $35 billion. Silver's total market cap was 14 times the value of the largest corporation. The ratio of silver market cap to leading company market cap was 14:1 in 1980 versus current 1.07.1, suggesting 1980 was far more extreme. But the 1980 episode was driven by manipulation. The Hunt brothers controlled over 100 million ounces and leveraged futures positions. When COMEX changed rules forcing liquidation, both metals collapsed 60-70% within months. The current episode lacks a manipulator. Buying is distributed across industrial users, central banks for gold, retail investors, and institutions. This makes the current dynamic more sustainable but also more concerning. It represents genuine market-driven capital reallocation rather than artificial corner. The aftermath of 1980 was 2 decades of bear market. Gold fell from $850 to $250 by 1999, a 71% decline over 19 years. Silver fell from $50 to $4 by 1999, a 92% decline. Current conditions differ materially. Central banks are not selling gold, they're buying. Mine production is constrained by base metal prices and declining ore grades. The Fed cannot replicate Volcker because federal debt at 123% of GDP and interest expense exceeding $1 trillion annually prevent aggressive tightening. The mechanisms that reversed 1980 are not available. The 2011 precious metals peak provides a more recent parallel. Gold reached $1,917 per ounce in September 2011, and silver hit $49 in April 2011. Gold's market cap at 6.5 billion ounces and 1,917 was 12.5 trillion. Global equity market cap was approximately $55 trillion. Gold represented 22.7% of global equities. Silver at 25 billion ounces and $49 had a market cap of $1.25 trillion, representing 2.2% of global equities. Apple's market cap in September 2011 was approximately $340 billion. Silver's market cap at $1.2 to $25 trillion was 3.6 times Apple's value, similar to the current inversion, but in the opposite direction. The parallel is that in both episodes, 2011 and 2026, precious metals achieved market caps exceeding or approaching dominant technology companies, signaling loss of confidence in financial assets. The 2011 episode ended when the Fed signaled QE2 would conclude without immediate QE3, reducing monetary debasement fears. European central banks' whatever it takes commitment in July 2012 stabilized sovereign debt markets. Precious metals corrected 40-50% over the following years as financial market confidence partially restored. The Weimar hyperinflation of 1921 and 1923 provides extreme precedent for complete capital flight from currency into tangibles. As the German mark collapsed, hard assets, real estate, commodities, precious metals, became the only stores of value. Accounts describe workers being paid twice daily and immediately purchasing goods before the currency lost additional value. Precious metals market caps in mark terms became essentially infinite as the mark approached zero value. The pattern across these precedents is consistent. Precious metals achieve elevated market caps relative to equities during periods of currency debasement, fiscal crisis, or loss of confidence in financial system stability. The metals do not generate earnings, so their market cap cannot be justified by traditional valuation. Their value derives entirely from perception, as stores of value superior to currency or financial claims. When that perception becomes widespread, capital flows create market cap inversions, like silver exceeding Apple. These inversions historically resolve either through policy stabilizing confidence in financial assets, allowing metals to correct, or through complete currency collapse, in which case metal market caps become essentially infinite in nominal terms. The mainstream financial narrative frames silver's market cap exceeding Apple as an anomaly, a temporary distortion that will correct once speculative excess subsides and investors return to productive assets generating cash flows. This framing serves multiple interests with incentives to downplay the signal's significance. The asset management industry's business model depends on assets under management in traditional securities, stocks and bonds. When capital rotates from equities into commodities, it creates problems. Commodity exposure is limited by fund mandates, creating regulatory barriers to following the flow. Additionally, commodities generate no management fees compared to actively managed equity funds. An investor holding silver directly pays zero fees. An investor in an equity mutual fund pays 0.5 to 2% annually. The industry's revenue model depends on maintaining capital in fee-generating financial assets rather than commodities. Technology company valuations depend on narratives of innovation, growth, and transformation. Apple's $3.85 trillion market cap is justified by projections of future services revenue, ecosystem expansion, and continued dominance. If the investment community acknowledges that silver, a commodity with no innovation, no growth, no transformation capacity, is worth more than Apple, it undermines the entire growth stock valuation framework. The narrative must be that silver is overvalued rather than Apple is overvalued, or that both are overvalued, but silver will correct first because it produces nothing. Central banks face credibility issues if precious metals achieve market caps indicating they are trusted more than government currencies and bonds. The Federal Reserve's mandate includes price stability. If silver at $108 reflects inflation expectations exceeding official 3% statistics, it suggests Fed policy is failing. Acknowledging this forces admitting that currency debasement is accelerating beyond control. The preferred narrative is that silver is experiencing a supply shock or speculative mania unrelated to monetary policy. The second-order effect being missed is the impact on industrial sectors dependent on affordable silver. Solar panel manufacturers designed products assuming $20 or $30 silver. At $108, the metal cost component has quadrupled, making panels uneconomical without dramatically higher subsidies or consumer prices. Governments have committed to net zero carbon emissions, requiring massive solar deployment. Rising silver costs force a choice: abandon climate goals, increase subsidies straining fiscal budgets, or delay targets acknowledging they were unrealistic at scale. Electric vehicle production faces similar constraints. EVs use 25-50 grams of silver in electrical systems. At $20 silver, this represented $20-40 per vehicle. At $108 silver, it is $90. At $108 per vehicle, a material cost increase for an industry operating on thin margins and depending on subsidies for demand. If silver remains elevated, EV production costs increase, prices rise, demand falls, deployment targets are missed. The green energy transition was designed assuming cheap silver would remain available indefinitely. That assumption is broken. The wealth transfer mechanism is underappreciated. Silver's market cap increasing from $874 billion to $4.1 trillion represents $3.2 trillion in gains for silver holders. This wealth came from somewhere, from those who held cash that depreciated in real terms, from those who held bonds with negative real yields, from those who held equities that underperformed. The $3.2 trillion wealth transfer is among the largest in financial history over a 24-month period for a single asset class. Those who recognized silver's monetary function and scarcity early gained massively. Those who followed traditional portfolio allocation advice lost purchasing power. The reflexivity dynamic is being ignored. Silver's market cap exceeding Apple creates media coverage. Media coverage increases retail awareness. Retail investors who previously ignored commodities now see silver as a legitimate asset class. Increased retail buying drives prices higher. Higher prices create more media coverage. The loop is self-reinforcing until something breaks it. Either supply increases materially, demand is destroyed through recession, or alternative assets become compelling. None of these catalysts are obvious currently. The systemic fragility emerging in derivative markets remains hidden. COMEX silver futures show open interest of 1.17 billion ounces against registered inventory of 43 million ounces, a 27.1 ratio. If silver's prominence increases further and more, contract holders demand physical delivery rather than cash settlement, the exchange faces stress. The market cap comparison to Apple draws attention to silver as an asset, increasing the probability that sophisticated investors recognize derivative stress and demand delivery, potentially triggering a squeeze that forces cash settlement, destroying confidence in paper silver pricing. The comparison itself reveals something profound that mainstream analysis misses entirely. Market cap is a consensus valuation mechanism. Silver's market cap exceeding Apple means the investment community collectively has decided that a finite stock of physical metal is more valuable than the present value of all future iPhone sales. All future services, revenue, all innovation capacity, all intellectual property, and all brand value of the world's most successful company. This consensus cannot form without deep skepticism about the value of financial claims versus tangible assets. The skepticism itself is the signal. The signal warns that the global financial system is experiencing a confidence breakdown where increasing amounts of capital no longer trust that financial assets, claims on future production, will preserve value better than tangible commodities that produce nothing. This represents a fundamental rejection of the premise underlying modern finance, that productive capital generating cash flows should command higher valuations than inert commodities. The first implication is that traditional valuation frameworks are losing relevance. Equity analysis depends on discounted cash flow models, price-to-earnings ratios, and return on invested capital. When silver with zero earnings commands higher market cap than Apple with $100 billion in earnings, it suggests investors are applying different valuation logic. That logic is counterparty risk and currency debasement outweigh cash flow generation. If this logic spreads beyond precious metals to other tangible assets, energy, industrial commodities, real estate, it creates systematic rotation from financial assets that could destabilize equity and bond markets. The second implication is that central banks are losing control of monetary perception. Central banks manage inflation expectations through forward guidance, interest rate policy, and balance sheet operations. But if silver's price is signaling that inflation expectations exceed official targets by a wide margin, it suggests forward guidance has lost credibility. Markets are price discovering inflation expectations through silver rather than trusting central bank communications. This undermines monetary policy effectiveness. If expectations cannot be anchored through communication, the only tool remaining is actual policy tightening, which is constrained by debt levels. The third implication is that the green energy transition faces input cost crises that threaten deployment timelines. Governments globally have committed to net zero emissions by 2050, requiring massive solar and EV deployment. Both depend on affordable silver. If silver remains at $108 or rises further, the economics of solar and EVs deteriorate, requiring either higher subsidies that strain fiscal budgets already running $2 trillion deficits, or higher consumer prices that reduce demand. The transition was designed assuming abundant, cheap inputs. That assumption is being tested. The fourth implication is that wealth inequality accelerates through asset composition. The wealthy hold diversified portfolios, including commodities, real estate, and alternative assets. The middle class holds 401k plans concentrated in domestic equities and bonds. When silver's market cap increases 369%, while the S&P 500 increases 37%, those holding diversified tangible assets gain 10 times more wealth than those following traditional financial planning advice. This wealth divergence creates political tension and questions about financial system fairness. The warning from historical precedents is that when precious metals achieve market caps approaching or exceeding dominant equities, it signals late-stage loss of confidence that resolves either through policy restoring confidence or through currency collapse. The 1980 episode resolved through Volcker tightening that broke inflation expectations, allowing metals to correct. The 2011 episode resolved through ECB intervention, stabilizing European debt markets. Current conditions differ. The Fed cannot replicate Volcker because debt service already exceeds $1 trillion annually, and there is no obvious policy intervention that simultaneously controls inflation, supports growth, and maintains financial stability. The signal warns that capital is making binary choices, financial assets or tangible assets, rather than holding balanced portfolios. When choices become binary, markets become unstable. Small shifts in sentiment create large capital flows. Silver, absorbing $133 billion monthly in market cap appreciation, indicates flows are already large and potentially accelerating. The system breaks when these flows overwhelm market capacity to absorb them smoothly. Silver's market capitalization crossed $4.1 trillion in January 2026, surpassing Apple's $3.85 trillion for the first time. A commodity metal with zero earnings, producing no cash flows, generating no intellectual property, now commands higher aggregate value than the most profitable company in human history. The comparison is not of equivalent assets. Apple is productive capital. Silver is a tangible commodity. But the inversion reveals collective investor judgment that tangible scarcity with no counterparty risk is preferable to claims on future earnings dependent on continued economic growth, stable currencies, and functional financial systems. The trajectory from $874 billion in January 2024 to $4.1 trillion in January 2026 represents a 369% increase in market cap in 24 months, 10 times faster than S&P 500 growth over the same period. This is not gradual reallocation. This is systematic capital flight from financial assets into tangibles. Historical precedents show precious metals achieve elevated market caps during periods of currency debasement, fiscal crisis, or financial system instability. The 1980 episode saw gold's market cap exceed the entire U.S. equity market before correcting when Volcker's tightening restored confidence. The 2011 episode saw silver reach 3.6 times Apple's market cap before correcting when central bank interventions stabilized European debt markets. Current conditions offer fewer obvious resolution mechanisms. The Fed cannot replicate Volcker because debt levels prevent aggressive tightening. Central banks cannot sell silver to suppress prices because they hold none. Alternative assets do not offer compelling value given elevated valuations across all financial markets. The signal is not that silver has reached a peak or that financial assets will collapse. The signal is that investor confidence in the preservation of wealth through financial claims is eroding in favor of tangible assets with no counterparty dependency. When that erosion reaches the point where a commodity metal is worth more than the world's dominant technology company, the question is not whether the signal is real. The question is, what breaks first, confidence in the metal or confidence in the claims?